In 1929, America was drunk on prosperity. Everyone believed the market could only rise, that a new age of wealth had arrived, that risk itself had been defeated. Ordinary workers were buying stocks on borrowed money, millionaires were minting fortunes overnight, and newspapers called it the permanent boom. But within weeks, that dream turned to dust. The same people who toasted to endless growth were standing in breadlines, watching banks lock their doors forever. What most people never learned is that the crash wasn't just bad luck or panic. It was built on a foundation of greed, easy credit, and blind faith in a system that quietly hollowed itself out. Every chart, every headline, every promise looked safe, until the moment it didn't. And almost a century later, the warning lights are flashing again. The generation that built its wealth on rising markets, low interest rates, and never-ending optimism, the baby boomers, now stands on the same fault line. Their retirement portfolios are bloated with debt-fueled assets. Their safety nets depend on the same illusion of endless growth, and one wrong move could erase everything they've earned. History doesn't repeat word for word, but when it comes to money, it rhymes like a haunting echo. The same confidence, the same mistakes, the same setup. So before the next collapse rewrites another generation's future, we need to uncover the real secrets of 1929 and understand why boomers may be just one bad trade away from ruin. The 1920s were the decade of unstoppable confidence. The Great War had ended. America was industrializing faster than any nation in history, and the stock market became the new religion. Every factory whistle, every new skyscraper, every roaring automobile on the streets whispered one message: the future would only get richer. Money was easy. Banks handed out loans like candy. People borrowed not just to build businesses but to gamble. On stocks, on land, on dreams. Even small-town clerks and barbers believed they could outsmart Wall Street. The radio filled homes with stock tips, and dinner tables buzzed with talk of can't-miss companies. Behind the excitement, something darker was forming. Stock prices weren't rising because companies were making more money. They were rising because people were borrowing more money to buy them. It was leverage stacked on leverage, optimism built on credit, and debt disguised as prosperity. The warning signs were everywhere. A handful of bankers quietly pulled out of the market. Economists whispered about overvaluation, but nobody wanted to hear it. After all, when your neighbor's getting rich, caution sounds like jealousy. By 1928, America's economy looked unstoppable. Record profits, record consumption, record belief in the illusion of control. But underneath, the system was rotting. It wasn't wealth being created. It was wealth being recycled through borrowed dollars. And like all illusions, it only needed one spark to collapse. The truth is, the 1920s didn't just build the greatest boom in modern history. They built the perfect setup for disaster, a setup frighteningly similar to what we're seeing today. The story of the 1929 crash didn't begin in panic. It began in euphoria. For years, Wall Street was the beating heart of a nation convinced it had found a financial miracle. Stocks had doubled, tripled, even quadrupled in value, and every new high was celebrated as proof that the system worked. But beneath that glittering surface, the game was rigged. Stockbrokers encouraged average Americans to buy on margin, meaning they could control $10,000 worth of stock with just $1,000 in cash. The rest was borrowed from the broker, who borrowed it from the bank, which borrowed it from the Federal Reserve. The entire financial tower was built on borrowed air. When prices rose, everyone got rich. When prices fell, even slightly, the entire pyramid began to crack. But in 1928, no one wanted to hear warnings. Even the legendary economist Irving Fisher declared, "Stock prices have reached what looks like a permanently high plateau." Those words became the curse of a generation. Meanwhile, the Federal Reserve faced a dilemma. The economy was overheating, but politicians demanded more growth. Sound familiar? So the Fed raised interest rates just a little, hoping to slow speculation. Instead, it triggered a chain reaction. Borrowed money became expensive. Margin calls flooded in. Investors were forced to sell, not because they wanted to, but because they had to. Then came October 24, 1929, the day history remembers as Black Thursday. The selling began early. At first, it was a trickle, then a wave, then an avalanche. Within hours, ticker tapes couldn't keep up with the chaos. Prices collapsed faster than they could be printed. Ordinary investors screamed into phone lines begging to sell before they lost everything. Banks tried to step in, announcing a rescue fund to calm the markets. It worked for 2 days. But by Black Tuesday, October 29th, panic had turned into apocalypse. 16 million shares changed hands, an all-time record. Companies that had seemed untouchable, General Electric, U.S. Steel, Radio Corporation of America, lost 70 to 90% of their value in a matter of hours. And when the dust settled, the real tragedy began. Millions of Americans discovered that their life savings were gone, not because they made bad choices, but because they trusted a system that was never built to protect them. The banks that had promised safety had gambled with deposits. The government that had promised stability had looked the other way. The roaring 1920s ended not with a whisper, but with the sound of collapse echoing across every town and city. Factories shut down. Farms went bankrupt. Men who once wore suits to work now stood in breadlines. Families sold everything, cars, jewelry, even furniture, just to survive another week. In a single year, unemployment soared from 3% to 25%. America's illusion of endless growth was gone, replaced by the Great Depression, the darkest economic winter in modern history. But perhaps the cruelest lesson of all came later. The people at the top walked away. The same bankers who fueled the bubble reinvented themselves as advisors, regulators, even heroes of the recovery. The small investors, the workers, the dreamers, they were the ones who paid the price. The rich had learned how to turn crisis into opportunity, and as decades passed, that lesson didn't fade. It evolved. Because every major crash since, from 1987 to 2008 to what's building today, follows the same hidden script. Easy money, blind optimism, rising leverage, and, finally, collapse. Each time, the tools get more sophisticated. But the psychology never changes. Greed, fear, denial, the holy trinity of financial disaster. The 1929 crash wasn't just an event. It was a revelation. Proof that markets aren't governed by logic but by emotion. Proof that the moment everyone believes they can't lose, they've already started losing. And proof that the same forces that destroyed fortunes a century ago are quietly building again in a world that believes it's too smart to repeat the past. Nearly a century later, the faces have changed, but the game hasn't. Today's market isn't driven by ticker tape and shouting brokers. It's driven by screens, algorithms, and retirement funds. Yet beneath the surface, the same forces that wrecked 1929 are alive and thriving, hidden behind modern names like monetary stimulus, quantitative easing, and leverage. After 2008, central banks did what every empire in decline has done. They printed. Trillions of dollars flooded into the system, inflating asset prices to record highs. Real estate, stocks, even art. Everything became a financial bubble, feeding on cheap money. And for the baby boomer generation, it felt like salvation. Their homes doubled in value, their portfolios soared, and retirement looked safe again. But it wasn't real safety. It was borrowed time. Just like the 1920s, prosperity was built on debt, not productivity. Corporations borrowed trillions to buy back their own stock. Governments borrowed to fund endless spending. Consumers borrowed to maintain lifestyles they couldn't afford. The entire system became addicted to credit, believing interest rates would never rise, that inflation would stay low forever. Then came the shock. When rates finally rose, the illusion cracked. The same easy money that had inflated markets started to choke them. Banks began to fail again, this time with digital runs instead of lines at the door. Retirement funds took hidden losses. And the generation that once benefited most from the boom found itself the most exposed to the bust. The parallels are chilling. In 1929, it was margin loans. Today, it's margin hidden in derivatives and ETFs. In 1929, speculation was driven by emotion. Today, it's driven by algorithms coded with that same emotion, greed and fear. The technology has evolved, but human nature hasn't. Boomers, in particular, now sit on the edge of history's rime. They control more than half of global wealth, but much of it exists only on paper. The stock market is their lifeline, their pension, their safety net. One wrong move by the Fed, one geopolitical shock, or one panic-driven sell-off could unravel decades of perceived security. And just like in 1929, confidence is the final pillar holding it all together. The moment that trust breaks, when people stop believing the system will always protect them, that's when history stops rhyming and starts repeating. Every financial disaster teaches the same lesson, but humanity keeps forgetting it. The 1929 crash wasn't just about numbers or markets. It was about belief. The belief that progress is automatic, that wealth can't vanish, that someone else will always catch the fall. That illusion still drives our world today. Lesson 1. Inflation and crashes are not accidents, they're policy. When governments print money to solve problems, they aren't fixing the system. They're feeding it temporary relief. The real cost always arrives later, in the form of lost savings, devalued currency, and shattered trust. The winners are those who own real assets, land, gold, businesses, not those holding paper promises. Lesson 2. Wealth built on confidence can disappear overnight. The moment people stop believing in the value of their money, their market, or their government's word, everything that depends on that faith collapses. That's why every boom carries the seed of its own destruction, because the higher the belief, the harder the fall. Lesson 3. History never punishes greed immediately. It waits until you forget it exists. That's what happened in 1929, in 2008, and it's what's happening now. The boomers, who rode the greatest wave of prosperity in human history, may soon discover that their greatest advantage, trust in endless growth, was also their biggest weakness. The real lesson is simple. Systems don't collapse when they run out of money. They collapse when they run out of trust. Rome thought it could stretch silver forever. America in 1929 thought prosperity would never end. And today, we think we've mastered the cycle, that technology, central banks, and data can protect us from the laws of history. But history doesn't take orders. It collects debts. Every empire, every market, every generation believes it's smarter than the last, until the chart turns red. The question isn't if the system will reset, it's who will be ready when it does. Because the next crash won't come with warnings or headlines. It'll come quietly, through your portfolio, your savings, your future. If you want to understand how money, power, and history keep repeating this same pattern, and how to protect yourself before it's too late, subscribe, because what's coming next will make 1929 look like a rehearsal.